the key thing I wanted to raise today is a new piece of legislation that was introduced in 2019, which has been, I think, fairly overlooked by advisors. This is called the profit fragmentation legislation in the UK. And what it does is take a lot of those concepts from diverted profits tax and apply them to companies of all sizes and to individuals in the UK as well. Now, these rules were introduced basically to prevent groups transferring value out of the UK where those transactions aren't on arm's length terms. So really what this does is import TP into the SME market. Now, HMRC, when they introduced the profit fragmentation rules, they confirmed they were really designed to just target the most aggressive of transactions. But the reality is they're very broad in their reach and they're very broadly worded. So groups of all sizes need to think about these rules. Now, one of the concepts in the profit fragmentation rules is the concept of a tax mismatch. And this again is taken from diverted profits tax. So you have a tax mismatch where you have a UK company or individual and they're making a payment or a transfer to an overseas entity. And where that overseas entity is paying tax at less than 80% of the UK rate, then this legislation can apply. And what that means is the UK corporation tax rate is currently 19%. So any transaction with an overseas company where the local rate is 15% or lower potentially is caught by these rules. And that would bring in a whole number of European and Asian jurisdictions. If you have an individual who could be paying tax at 45% in the UK, if they move income or assets overseas, the 80% of 45% is obviously much, much higher. So again, these profit fragmentation rules really do bring in the TP legislation to the SME market.
Transfer pricing is probably the number one issue for all companies doing business cross-border in this part of the world. Many of the tax authorities in Asia are very aggressive with their application of transfer pricing rules. Notably, Japan, Korea, India, China, and even Australia regularly come up as top of the list in terms of the most aggressive tax authorities in dealing with transfer pricing. It's also important, I think, to realize that many of the jurisdictions in Asia have somewhat unique approaches to transfer pricing, and not all of them are members of the OECD. So appealing to OECD guidance and those sort of things doesn't necessarily get you very far with when dealing with tax authorities in this part of the world. Even our good friends in Korea and Japan, which are members of the OECD, seem to take divergent views when it suits them on the application of transfer pricing principles. As James alluded to, typically we think of transfer pricing and the big end of town in terms of companies, but in almost all jurisdictions in this part of the world, transfer pricing applies to all related party transactions. So the mere fact that you are not a large company may mean you are less likely to have to do the documentation. So, in Hong Kong, there is a threshold, both in terms of business size and transactions scope, that may limit your requirement to do transfer pricing documentation or formal documentation. But the rules do apply, and there is no de minimis threshold.